In this video, as a continuation of John Murphy's technical analysis, we want to talk about Dow's theories. Stay with me. In this video, we want to talk about John Murphy's technical analysis and Dow's theories. Dow's theories are discussed in the first pages of John Murphy's book, which shows how important they are. Therefore, we need to examine this very carefully to see what topics we are talking about. Some parts of it relate to the same assumptions that we reviewed together in previous videos. Well, look, Mr. Dow says in the first section that the priority is with the market's behavior. This is exactly what we discussed together in the previous part. From John Murphy's perspective as well, it was the same, that the priority is with the market's behavior. There we examined together what this means. It means that when the price reaches a certain level, it doesn't matter why it got there. What matters is that it has moved and reached that price now. Analyzing the reasons, as they say, has nothing to do with technical analysis, and we don't get involved with it. The next topic in Dow theory is that price, or the market itself, has three trends. These three trends are upward, downward, and neutral. There are no trends outside of these three. In any case, the market is either going up, going down, or it's neutral, meaning it's neither rising nor falling. It's moving roughly between two prices. But the third rule talks about the fact that in each of these trends, we have three parts: the main part, the secondary part, and the minor parts. The main part is, of course, the primary trend that we have. Now, whether it's an uptrend or a downtrend, for example, in an uptrend, the main trend or the main part is upward, but the secondary part means that within that same uptrend, there are also downward movements in its sections, and the minor or small movements are what we call the minor parts. These are the small upward and downward movements that you see within those secondary movements. But the next point is that the main trend itself consists of three parts. The first part is the accumulation phase. The accumulation phase, or accumulation, means that at a certain point in the market, the big players, or so-called whales, start accumulating that asset. In other words, they start buying and transfer it to their own wallets and hold on to it. This is exactly the period when there is bad and discouraging news in the market. For example, if you've noticed, or if you check the chart now as I'm saying this, you'll see that during the period when the news about COVID-19 or the coronavirus came out in 2020, the market started moving downward and experienced a very sharp drop. Well, at this stage, you can see that accumulation took place and the big players in the market started buying Bitcoin and the cryptocurrencies they were interested in. But the second stage is the growth phase, meaning that after the big players start buying, you'll see the growth phase happen and the smaller players begin to buy. That is, after the whales, the smaller players or those with less capital start buying from the market. This stage is called the growth phase or the entry of ordinary people. The third stage is the distribution phase. In this stage, you can see that the best news is being broadcast. That is, you see everywhere people are talking about how Bitcoin is going to reach, for example, 100,000 and similar news. For example, in the bull run of 2020 and 2021, you could see that towards the end of the bull run, people were talking about Bitcoin reaching 100,000. While in reality, during that bull run, this price was never reached. And from 67,000, the bear market started and the price moved downward. We call this stage the distribution phase. And this is exactly the stage where you should have started exiting the market beforehand, so you don't get caught off guard. But the fourth point regarding Dow theory is that all indices must confirm each other and create a new high. This means that when you look at the market indices, all the indices you are considering should confirm each other. When they do not all confirm each other, then the situation is suspicious and you should refrain from entering the market. Next, Mr. John Murphy, in his book, has overlaid these two charts, and as you can see, both are confirming each other. That is both transportation and industry. They are confirming each other and moving upward. But regarding the fifth and indeed very crucial point from Mr. Dow's well-established theories, it is fundamentally that trading volume should consistently confirm the prevailing trend. This essentially means that when the price of an asset is actively moving upward, the corresponding trading volume should also significantly increase as the price steadily rises, indicating strong buying interest and market participation. If you see that the price is moving up, but the volume isn't increasing, it means you haven't received the necessary confirmation. And even if the price is moving downward, the volume should still confirm it. Now, how exactly volume should confirm the price is a topic we need to discuss in other videos before we continue reviewing the rest of this video together. I'd appreciate it if you subscribe to the channel and hit the bell so you'll be notified as soon as a new tutorial is released. But the sixth point that Mr. Dow discusses in his theories is that a trend remains in place until it is proven otherwise. This is exactly Newton's first law. What did Newton's first law say? An object keeps moving until a force stops its motion, or an object remains at rest until a force causes it to move. Therefore, when you see that there is an upward trend, it means the trend is upward unless it is proven to you that the trend has changed and become downward, and the opposite is also true. But if we want to look at this topic of trend reversal together in the form of a schematic chart, imagine that the price is moving upward here, makes a small correction, then moves upward again and reaches a certain point. Again, it makes a small correction, reaches point B, then moves upward once more and gets to point C. From point C, it starts to correct, and this time it reaches point D in such a way that it breaks the first support level and moves downward. At point S1, that break occurs. Again, the price makes an upward correction, reaches point A, and once more the price corrects and moves downward in such a way that it breaks the second support at point S2. This is precisely where we can confidently state that it has become abundantly clear to us that the prevailing uptrend has definitively shifted, transforming into a distinct and undeniable downtrend.